Good morning, Gizla Madam. Good
Good
morning,
morning.
Gizla Madam.
Good morning, Meenakshi Ma'am.
On behalf of JSPM's Rajshri Shahu College of Engineering, I welcome Professor Gizla Makhija Madam. She is our alumni and she is a topper of the batch 2014-16. She is having an experience of more than 16 years in the field of management. She has published more than 3 papers in the field of management, and she has written or she has authored more than 5 books in the field of the finance. I welcome Professor Gizla Makhija Madam to share your valuable thoughts on the regulatory framework. Over to Gizla.
Thank you so much, Meenakshi Ma'am, for wonderful and overwhelming introduction. Good afternoon to one and all present here. It's given me an immense pleasure to be always here with young, bright minds of JSPM MBA students. So now, without much delay, let's get right into the session. I will be sharing my screen now and would like to request all of you to mute yourself so that to avoid the unnecessary disturbance. It will take me a few seconds. Yes. Meenakshi Ma'am, is my screen visible?
Yes, madam. Please start.
If you have something to share, so please feel free to use the chat option, and there is a reaction option also. I would really appreciate if you use it liberally so that I know that I am moving in right direction. So let's dive straight into the topic of today, that is regulatory framework. So welcome you all students for this MBA session. What is regulation? Regulation means a set of binding rules issued by a public or a private body with the necessary authority to supervise the compliance with them and take action in case of violation of rules. Regulation means to regulate, to direct, to move in a desired direction. So basically 3 things which are involved over here is making of the rules and then supervising their compliance and taking necessary actions in case of violation of rules. Now come to regulatory framework. It is a system of rules and regulation and the means used to enforce them established by government in order to protect the interest of the various parties associated with the activity or for the orderly conduct of the activity. Now we come to financial regulation. It is the rules, laws that govern the financial institutions, their affairs, like banks, brokers, investment companies, and other development institutions. These rules are generally formulated by government regulators like RBI, SEBI, IRDA to protect the investors and to maintain orderly markets and promote financial stability. So this is what financial regulation is all about. It is about supervision of financial institutions by government for effective functioning of financial system. It may take the following activities, like it may ask the financial product providers and distributors to register themselves. It may set out the code of conduct, that is broad principles by which regulated business is expected to be conducted, and then setting the minimum standards for capital. It can also make rules regarding the commissions and fees chargeable by entities for their financial services. Then they require periodical information about the activities of the entities and impose some restriction on their functioning if they feel that some activities are against the rules and regulation. Then regular inspection, investigation, and prosecuting misconduct. These are all the range of activities which the financial regulators actually can take upon. Now, what was the goal of financial regulation? It was price stability, protecting the small investors, preventing market misconduct, reduction of systemic risk, safety and soundness, transparency in financial dealings, fairness of customer treatment, disclosure and reporting, dispute resolution and settlement. Now we shall discuss each one separately. Under price stability, one regulates the market to maintain the general price level in the economy. It actually involves avoiding long-standing inflation and deflation. It naturally will contribute to the high level of economic growth and activity, employment in the economy. So basically, this allows them to make well-informed consumption and investment decisions and to allocate the resources more efficiently. Then comes protecting the small investors from misleading, manipulative, fraudulent practices, including insider trading, front running, or trading ahead of customers, and misuse of client asset. And for this, the full disclosure of information in the form of transactions, purchases, affairs of the companies, important investment decisions, these all have to be taken care of to protect the investors. Then preventing market misconduct. Another objective is to prevent unfair practices and market misconduct. Regulation should detect, deter, penalize market manipulators and other malpractices which are going on in the market. So only licensed and authorized persons should be permitted to take up the investment services or for providing the investment services. Supervision of market intermediaries should achieve maximum protection by setting up the minimum standards for market participants. So all this will help in instilling confidence among the small investors to invest in the financial sector. Now, reduction of systemic risk. Systemic risk is inherent in the entire market or market segment. It is not related to a particular stock or industry, and it is both unpredictable and we cannot avoid it. It can be mitigated though through diversification, or we can say diversified portfolio. So it is distinguished from the unsystematic risk, which impacts only a specific industry or security. Then we come to safety and soundness of investors by making free and fair access to the market facilities and market or price information. So fraud and manipulation of market prices actually rob the investors of their fair money and fair return on the money, and that discourages investment and harms the entire economy. So for this, full disclosure of information regarding the company's affairs, the transactions, and the code of conduct is very important. Transparency in financial dealings. Now, what is transparency? It is the degree of information which is made available to public on real-time basis, and it will ensure the fair treatment of orders and a price formation process that is reliable. So for dissemination of relevant information, it should be timely and widespread, and it should be on real-time basis. Now, fairness of customer treatment. It involves protection of investors' interest and prevention of improper trading practices. So basically, investors should be treated fair and equitable manner in market intermediaries according to the set standards, rules of business conduct. And regulation should be such that it should detect, deter, and penalize those market manipulators who are involved in unfair trading practices. Then we come to disclosure and reporting. All the accounting policies, balance sheet, valuation techniques, and the reports, whether it is special or regular, all the events should be disclosed properly. And for this, there should be a comprehensive system of inspection, surveillance, compliance of the programs. Now, dispute resolution and settlement. In case of any grievance, the investors should have access to the neutral mechanisms such as courts or dispute resolutions, a means to redress and compensate for the improper behavior. So basically, investors should be protected through the strong enforcement of law. So now we come to structure of regulatory framework in India. It starts with Ministry of Finance, under which we have regulatory bodies like RBI, SABI, IRDA, and PFRDA. And under which we have, like RBI, we have commercial banks, non-banking financial companies, National Housing Board, and housing finance companies. Under SABI, we have stock exchanges, mutual funds, portfolio managers. These two we will take up in our next session also. Insurance Regulatory and Development Authority. Under that, we have Life Insurance Corporation, non-life insurance corporate companies, reinsurance, insurance brokers, All these, and then pension fund managers and intermediaries are under PFRDA. So these are the regulatory bodies. And then we have quasi-regulatory agencies like NABARD, NHB, that is National Housing Bank. Then we have SIDBI, that is Small Industry Development Bank of India. Then we have central government ministries, state governments, Financial Sector Development Council. Let's take one by one. Now come to RBI. Now RBI regulates and supervise the major part of the financial system. The financial system comprises of 60% of the commercial banks. So basically the RBIs are regulating and supervising all these commercial banks, urban cooperative banks, the credit products, the savings and the remittances and all this, which is in the financial sector. Now, SEBI, that is Security Exchange Board of India, is interested by its act to regulate the capital market investment products in India. Capital market, mutual fund, capital market intermediaries are all regulated by SEBI. So basically it is managing the IPOs, the issue of the debentures, venture capital fund, mutual fund, all are regulated by SEBI. Now, Insurance Regulatory Authority of India is the next regulator. It has been established with the objective to regulate, promote, and ensure orderly growth of insurance business in India. So it regulates the investment of funds by the policy holders, by the insurance companies, and protect the interest of policy holders. Now, next comes Pension Fund Regulatory Development Authority. It was established by Government of India on 23rd August 2003 to promote old age income security by establishing, developing and regulating pension fund to protect the interest of old age people. So it basically regulates the new pension scheme, that is NPS. Now, Forward Market Commission, it is the chief regulator of forward and future markets in India. It is a statutory body set up in 1953 under Forward Contract Regulation Act 1952. So it is a regulatory authority which is overseen by Ministry of Finance, Government of India. So these 5 are the regulatory bodies under regulatory framework in India. Now comes quasi-regulatory agencies. We have 3 quasi-regulatory agencies, that is National Board for Agriculture and Rural Development, National Housing Bank, and Small Industries Development Bank of India. So National Board for Agriculture and Rural Development, also known as NABARD, it is the bank for the rural sector. So it supervises regional rural banks and cooperative banks which are in rural areas. It supervises, facilitates the credit flow for the development of agriculture, small-scale industries, cottage industries, handicrafts, etc. And then National Housing Bank, it is a wholly owned subsidiary of RBI. It acts as an apex-level institution for housing finance. It promotes a sound, healthy, viable, cost-effective housing financial system to all the segments of the population. And basically it integrates the financial system with the housing system. Small Industries Development Bank, it was established in April 2, 1990 under the Act of Indian Parliament, and it was set up for promoting, financing and developing micro, small and medium enterprise sector. Now comes central government ministries. So besides these regulatory and quasi-regulatory, we have ministries of central government to regulate the financial sector by participating in decision making. Now how they are going to participate? They have representatives on the boards of SEBI, IRDA and RBI. So like Ministry of Finance and Ministry of Small Scale Industries have representatives on SIDBI, and Ministry of Urban Development is represented on National Housing Board. Then comes state government. State government regulates the cooperatives through the Registrar of Cooperatives. Then comes Financial Sector Development Council. Basically, it is a council of regulators. It is entrusted with the task of resolving the interagency disputes. Now, this is all about the structure of regulatory framework. Now we come to the salient features of the present regulation. Present regulation in India is product-based regulation, and each product is regulated by a separate regulatory authority. Like fixed deposit and other banking products are regulated by RBI, Small saving products by Government of India, mutual funds, equity markets and other intermediaries are regulated by SEBI. Insurance products are regulated by Insurance Regulation Development Authority. NPS and other pension funds are regulated by PFRDA. These all 5 regulatories we have all discussed earlier. Now, due to the existence of the product-based regulations, institutions face dual control, or you can say multiple control, by regulatory authorities. Like the banking function of the cooperatives is supervised by the NABARD and RBI, whereas the accounts, audit and management is controlled by the respective state governments through registrar of corporations. So regulatory authorities have come up over the period of time with the need of the financial sector in India, and each regulator has its own registration rules, its own codes of conduct, guidelines for functioning of the product providers and distributors. So this is it with the regulatory framework. Now we move to Banking Regulation Act. So the purpose of enacting the Banking Regulation Act was to consolidate and amend the law related to banking and to provide RBI with the powers to regulate the banking system. So basically this act came into force on 16th March 1949 and it extends to whole of India. Term banking according to Banking Regulation Act is defined as acceptance for the purpose of lending and investment of deposits of money from public, repayable on demand or otherwise, and withdrawal by check, draft, order or otherwise. So this was according to Section 5 of Banking Regulation Act. The characteristics of banking are to accept the deposit from public, pay checks, act as an intermediary, to invest public money for investment and credit purpose. A banking business is thus involves collection of money from those who have the extra money to spare and lending to those who require it for naturally for building up infrastructure or investment purpose. A banking company is not permitted to engage itself in any form of business other than those mentioned in Section 6(1)(a) to E of the Act, which we will learn further. Before that, let us come to the salient features of Banking Regulation Act. I will touch upon only the important ones. Like first one, no company other than the banking company is permitted to use as part of its name word like bank, banker, banking. So these words no other company can use except for the banks. Then for domestic banks, the minimum paid up capital or reserve requirement is, you can say, not less than 5 lakhs. A banking company can also issue equity shares and preference shares. Now, as per the capital structure, the ratio of authorized, subscribed, paid up capital must be minimum 4:2:1. And a shareholder is, irrespective of his holding, cannot exercise more than 10% of the total voting rights of all shareholders of the bank. So this is a condition for a shareholder. Then comes cash reserve for the non-scheduled banks. So with the scheduled banks, they are already maintaining the cash reserve, but the non-scheduled banks are also required to maintain the cash reserve at least 3% of its total time and demand liabilities in India as on the last Friday of the second preceding fortnight. Investment on share capital of other companies and maximum amount of advance against the shares of a particular company should not exceed 30% of the paid up capital of that company or 30% of its own paid up share capital and reserve, whichever is less. So this is a condition again on the investment. And then advance by a bank against its own shares, which is not allowed. They cannot advance on the security of its own shares. Then selective credit control under this Section 21 empowers RBI to determine the policy in relation to the advances which the banking companies can deal with. It can give the following directions to the banking companies related to the purpose for which the bank can give the advance, the margins to be maintained, maximum amount of advance which can be given, rate of interest, and the terms and conditions on which the advance can be made. So this was related to selective control, credit control, and now we come to licensing of banks. Banking companies required to obtain license from bank before carrying on the banking business, and then branch licensing also for any shifting of the branch, opening of the branch, or any place of the business. Prior permission of the RBI is required. Statutory liquidity ratio, that is SLR, according to section 24. Currently it is 18.50. It has to be maintained on the daily basis, and it means the ratio of specified liquid asset to the net demand and term liabilities of the bank. And liquid asset are like cash, gold, and unencumbered SLR securities. Then comes asset ratio. Asset ratio should not be less than 75% of its demand and time liabilities in India as on last Friday of every quarter. Then every bank must submit a return on assets and liabilities and as on the last Friday of every month. Then balance sheet and profit and loss must be prepared in format A and B given in the third schedule of the Act as amended in 1991. The balance sheet has 16 schedules. Then power to RBI to inspect the banks. According to section 35, it can issue directions to bank as it deems fit, and all the banks are bound to comply with such directions. Then power of central government to make rules for the preservation of records. So it is empowered to specify the period for which the banking company shall preserve its books of accounts and documents. And central government in consultation with RBI can also make rules in general on the conduct of banking business in India. Now we come to functions of bank, which are classified into two categories, primary functions and secondary functions. Under primary functions, we have accepting of deposits, granting of loans and advances. Under secondary functions, we have agency functions and general utility functions. So we shall take up each one separately. Accepting deposits. So bank collects deposits from the public. These deposits can be of different types like saving deposits, current deposits, fixed deposits, recurring deposits. We need not go through in detail about them. Granting of loans and advances. So banks also grant loans to the business community and other members of the public in the form of overdraft, cash credit, loans, discounting bills of exchange. Naturally, it will charge a higher rate of interest on these loans and advances as compared to the deposit, and the difference between the lending rate and the deposit interest rate is its profit. Now we come to secondary functions of bank. So bank performs a number of secondary functions which are known as non-banking functions like agency function and general utility. So like as an agency function, the bank acts as an agent of its customer. It performs number of functions like transfer of funds from one branch to another, collection of checks through clearing section or bills of exchange, periodic payments through standing instructions of clients, portfolio management, that is purchase, sale of shares, debentures on behalf of clients, and other agency functions like it can act as a trustee, executor, advisor, and administrator on behalf of client. They act as a representative of client to deal with other banks and institutions. Now, general utility function will include issue of draft, letter of credit, traveler's check also, locker facility for safe custody of valuables, underwriting of shares, debentures through its merchant banking division, dealing on foreign exchange as per the guidelines of RBI, project reports on behalf of its clients, social welfare programs, for example, adult literacy programs, act as a referee to financial standing of its customers. It collects creditworthiness information about clients of its customers. So this is it for today. Hope you have understood these two important topics of regulatory framework, that is the structure of regulatory framework and Banking Regulation Act 1949. Thank you once again, all of you. Over to Meenakshi ma'am.
Thank you, Gizla Madam, for your valuable inputs. Thank you very much. And you have explained very well regulatory framework of the operations and banking subject, and hope so that in the future time period also, you will explain some more topics like RBI and its functions, and two more topics.
Yes,
And
next time
we
I'm
hope,
going to take the important topics of RBI and SABI. And for
yes,
this session, all the doubts can be cleared later on. We
yes,
are
thank
running
you very
short
much.
of time. Yes.
Yes, sir. If the students are having doubts, then I'll definitely arrange one more session specifically for this session, regulatory framework.
Okay.
And at that time, you please clear all the doubts. Thank you very much,
Yes.
Gizla
Sure.
Madam, for sparing your valuable time and sparing your valuable inputs also with our students. Thank you
so
much.
much.
Thank you.
Thank you so much, ma'am.
Take care,
It's my
ma'am. Stay
pleasure.
home. Stay. Yes.
Same
Thank
to
you,
you.
madam. Thank you.
Yes. Thank you.